Guys, good morning. Welcome to the weekend edition of 13 Market Moves. In this edition, we're going to talk about the history of buybacks. I've been getting a lot of questions from many subscribers and VIP members. Hey, what's going on with the buyback situation? How can we profit from this? So that's exactly what we're going to talk about in this video. The cons, the pros, how to use this in trading the markets in the current situation. And by the way, we're going to answer the question, who the hell is buying this market right now? So without any further ado, let's dip into the history of the situation that creates every history of the market crash throughout the stock market history here in the United States. The root of every stock market crash is the abuse of leverage, also known as margin, any type of borrowing to actually artificially drive prices up without production or creation of any value in the process. And we have a headline here, billions lost in stock crash. Guys, history keeps repeating itself. Just a few time frames that are well known, 1929, 87, 2008, 2020, but also many smaller ones in between, which we have pointed out, such as a couple of instances in the last 24 months before we nailed this crazy crash of 2020. There were multiple instances in 2018 where the market has corrected by 10-15%, which the 13 Markets Move nailed accurately and provided substantial profits for our paying members. Now, current debate over stock buybacks goes back to almost 100 years. Look at this, February 21st, 1932. They were talking about it back then. Very similar to what you see in the headlines of some of the financial newspapers today. So any abuses, weakening of corporation cash position, regulation, all of that stuff dates way back. Excessive speculative activity by some managements in the shares of their own companies. This is from 1932, guys. Sounds almost identical what's going on right now. So this led to a 1934 Reform Act of Security Exchange Commission, the Exchange Act of 1934. Basically, buybacks were considered a form of market manipulation. So Exchange Act prohibits various forms of market manipulation. Stock buybacks qualify as market manipulation. Fast forward to 1982. Go right ahead. No big deal. We're fine with market manipulation. Security and Exchange Commission Rule 10b-18. Safe harbor from market manipulation liability for stock buybacks. Now, this in part is responsible for the shocking truth about the market I'm about to reveal to you in one simple table. If it would have crashed 4 years ago without any coronavirus, guys, if it wasn't for this, and of course what we're referring to, this stock buybacks. Look at this crazy table right here. So if we were to combine all the purchases of United States equities stocks, okay, take a look at 2019. So we had corporations buying up their own shares, net buying 480 billion. Yeah, foreign investors were actually pulling their money out, minus 175 billion. We have households buying, net buying 145 billion. Have mutual funds getting out, minus 150 billion. Pension funds, minus 200. Okay, the only reason the market has actually gone higher in 2019, okay, is because of the corporations. Because if we take this number out, if there was no buybacks, okay, you would actually arrive at a negative of 380 billion. In other words, there would be more net selling in the stock market, not by 20 billion, not by 30 billion. It would be net negative by 380 billion. There's no way the stock market would have been near the levels to which it was able to advance in 2019. Guys, understand that if you apply the same math to 2016, 17, 18, all of these numbers would have been negative. Yes, if you take the corporations buying their shares back during any one of these years, United States market would have not gone higher at any point in one of those years. It would have actually dropped because net people would be selling the hell out of shares in the market. So that's why we're saying the crash should have happened 4 years ago. And the only reason it didn't was because of the companies buying their shares back. So there was another time frame in the history similar to that, actually going to 1982, 1987. Remember how crazily the markets were moving higher. Well, it was all due to this insane increase in the stock buybacks. In 1983, 1984, literally tripled, right? Stock buybacks underwent tremendous growth during 83, 84, and the trend continued from there on. 1982 SEC rule, Securities and Exchange Commission, under Reagan administration pretty much opened the stock buyback floodgates by making them 100% legal. Okay, so now with the Trump administration, pretty much Trump considers Reagan as his hero, so pretty much it's really easy to see the similarities in a lot of aspects. So we equate Trump to Reaganomics on steroids, powered by low interest rates. For example, if you consider Reaganomics, the tariffs, the trades, deficits, the budget deficits, all of this is a perfect mirror reflection during the Trump administration, with the exception that it's all powered by these low, crazy interest rate environment. So it makes the situation entirely worse. Now, one crucial aspect limited buybacks from escalating to the moon in 1980s compared to the current time. Of course, guess what it is? I just gave you the answer to that. It's the interest rates. In 1980s, the interest rates were historically at their highs, anywhere from, depending on which year you take, from 7% all the way as high as 18%. They literally had like 18% freaking mortgage rates back in the 1980s at some point. So basically, companies were not dumb to borrow the money at 18% and then use them for buybacks. What they were relying to was solely their profits, okay, their net income to actually buy their shares back. So in contrast, going to 2011, 2020, lowest interest rates in the history of the United States. Of course, that created the corporate bubble and took buyback chart into the stratosphere. Okay, abuse of the leverage never ends well. Prime example, guys, is 1929. So here's, man, this chart is the only other chart that exceeds probably the buyback chart was the chart of Bitcoin in December of 2017. So crazy abuse of the low interest rate environment. Pretty much buybacks on steroids is how we can characterize this time frame in the history from 2009 all the way through 2000. Now, here's the question of the day. Okay, if the corporations were on such a huge buying spree through the last 10 years, why the hell the outstanding shares of S&P 500 only drop by 1%? Okay, if they keep buying enormous shares back, shouldn't we see the outstanding shares of S&P 500 decline substantially, not by 1%? If you take the year, one of the biggest years of buybacks was 2016, okay, the outstanding shares in S&P 500 actually go up. You see this green dot I got right here, guys? This is absolutely insane. How can this be? Well, this is quite simple, guys. I mean, if you're trading the markets, you should know there's two ways how companies can raise cash. Well, they can issue bonds, or they can offer secondary offerings by selling more shares of their companies. So hold on, Leonardo, are you saying, oh my God, is this really legal? You mean a company can actually buy shares back and issue more shares within the same year? Holy shit, why didn't I ever think about this? Oh my God, what a Ponzi scheme. Damn it. Well, that explains this chart right here. So they keep buying a ton of shares back to artificially maintain the higher price levels and to drive the prices higher, while indeed at the same time they're offering more shares in the open market by doing secondary offerings, okay, which actually decrease the value of each share, but they're able to overall drive the markets higher by consistently borrowing money at the lower interest rates to keep up with the share offerings. Damn, this is absolutely insane if you think about it, guys. So this is not even the end of stupidity, okay? The question is simple. Okay, why a company like AZO, or it could be any other company for that matter, who has been buying shares for decades, never ends up in a situation where it end up buying all the outstanding shares or the entire company. Like, even if you take old companies like AT&T, right, it's been buying shares for 100 years. It's been buying shares back for 100 years. Okay, why has it not bought all these shares back yet? Well, the answer is simple. So I'll give you just a moment to answer this question, guys. Okay, why some companies never end up buying out the entire company? Because they keep buying the shares back consistently, right? Why is that they can never buy the entire company back? All right, well, the answer is here, guys. It's because they also issue the new shares, right? So this is how crazy this is. They issue shares which dilutes the very value of the shares that they're buying through the buybacks. Absolutely insane. Now, the idea of buybacks is this, okay? Companies are supposed to be buying their shares back when they are considering their shares to be undervalued, when there is no other alternative for a better investment, okay? So clearly companies have options to reinvest the capital into a worthy project. They can invest it in research and development. They can buy properties, real estate to expand offices, hire new people, pay people more. There's a ton of stuff they could be doing with this money, okay? But technically they're supposed to be using the money for the buybacks. The theory of it is when they consider their shares to be undervalued, which would be a benefit to the shareholder, okay? So basically, use share buybacks if there's no better alternative of investment at that point if you're a company. So let me show you on this chart how well these companies actually know when the shares of their companies are undervalued. Here's all that's represented by all the times that the companies kept buying shares back at insanely high prices, which they thought were undervalued. And so now, when the market is down 30%, what happens? Well, they've used up all the freaking resources and money, borrowing them at this cheap interest rates. They bought their shares back. They're now worth 30% less. And if you study the history, this is actually not the only time frame in the United States history. Technically, companies actually have no clue when their shares are overvalued, undervalued, or whatever the heck is going on. And most of the time, they buy them at the top with the few rare exceptions. So before I show you a couple more examples, let me just make this point. So it was due to this stock buybacks that the market was rallying to all-time highs in the last couple of years, okay? And notice how poor the timing of these corporations were to actually buy the shares back. But that is why we're hitting all-time highs while the market should have actually been dropping long time ago. So U.S. Airlines spent 96% of free cash flow on buybacks. When? Before the crash in the last few years, okay? So U.S. Airlines collectively spent 96%, okay, on buying their shares back. Now, considering this is like a highly cyclical industry, right? I mean, not so long ago in 2008, they were needing bailout. I remember American Airlines shares were like $1 on the verge of a bankruptcy before they got bailed out. So, the history repeats itself, yet these guys, knowing how cyclical their business is, they continued buying shares back at all-time highs. And so now when the market is down 30%, they should be actually buying their shares back, okay, because it makes more sense. They are out of funds. They can't borrow. Their ratings are slashed. They cannot go and borrow money for the buybacks anymore. So they end up owning a ton of shares at the stupidly high prices. Okay, and now they're seeking the government bailout. Now, another example that's a little bit less recent, just to prove the point, how serious the problem really is. CEO of Sears, now Sears filed for bankruptcy, right? He was buying a ton of shares back at high prices, okay, not long before a company actually filed for bankruptcy. So he could have used the money to improve the business model. He could have used the money to save the jobs for thousands of people. He could have done a ton of stuff with that money. Yet, he went ahead and did the buybacks not right before the company files for BK. How crazy is this? Now, here's the issue now. Now that the market is priced at much better prices, okay, most of the companies are actually canceling their stock buybacks. And we're not talking about companies like Sears that went bankrupt in the last couple of years. We're talking about big heavy hitters like JP Morgan, suspends their share purchase. McDonald's, done. No more buybacks, okay? So this is a serious issue. Now that the market is 30% less than where it was not so long ago, they're actually canceling their buybacks where they should be using this opportunity to buy some more shares back. At least that would have represented a much better level in relation to what they were doing. So no brainer here. Corporate debt chart identical to buyback. So this is a high positive correlation between companies borrowing money, and instead of using them on productive resources, investments, and advancing their business production further, they were simply using them for buybacks. This is the chart representing their borrowing. Okay, so basically their borrowing was growing much faster than their earnings, and they were using the funds to buy the stock backs, and that is why the buyback chart looks like this. So super positive correlation between companies borrowing funds and the amount of buybacks. Okay, the chart is pretty much identical here, guys. So who's responsible? Who made the buybacks easier? Well, Trump, clearly. Tax cuts, 2017, market goes higher on the news of the tax cuts, right? So that's created extra cash flow, extra money in the hands of corporations. And so the idea was good. The idea was just like, the idea of communism was good. It was to make everybody equally rich, with the opposite effect that actually made everybody equally poor. The same thing here with tax cuts. The idea was good. It was to make the economy better, to create more jobs. But in reality, instead of doing that, United States corporation took the money and simply bought the shares back. So a lot of money was wasted on buybacks. Also, another culprit here is the Fed, with the lowest interest rates in history. So never in the history of the United States were the companies able to borrow money so cheaply. And clearly, when you borrow money and you just simply buy shares back, nothing is being created in the process. There's no type of production. So the major issues with the buybacks, guys, and this is just to name a few, okay, they create inflated stock prices. They help greedy CEOs get Fed bonuses. A lot of CEO structure is based on how far can they drive the stock price of the company higher. So a lot of their performance is tied to the stock price, short-term stock price. Number three, they help misguide public about the financial information, such as earnings per share. Now, considering that earnings per share on Wall Street and Main Street sort of used as a key metric for stock price valuation. Now, if you follow our channel, if you followed our formula, the 13 Market Smooth formula, we don't use any kind of metrics like earnings per share. That's why we're a lot more precise in identifying key pivotal points in the market. But majority of the people, they still use this old age earnings per share, which really means nothing these days, okay? But the idea is this. To help you understand the earnings per share, for those of you that may be brand new, let me just give you a quick example so you can understand. So earnings per share is derived, simply put, by the amount of money that a corporation makes divided by the number of shares. So an easy way to manipulate the outcome, which is earnings per share, the higher the earnings per share, the higher the value of the company is perceived to be, and the higher the valuation of its shares should be in the marketplace. So basically the way this works is, let's pretend that the company only has 100 shares outstanding. And let's say that it makes $240. So if you take the earnings of the company, which is $240, and you divide it by 100 shares outstanding, you would arrive at a figure of 2.4. So $2.40 would be earnings per each share. Now, the company decides to buy 20% of its shares back. So now instead of 100 shares, you only have 80 shares. Let's say the company makes the same amount of money, which is 240. You take 240 divided by 80. Now the same company is actually making or reporting on their financial statements that it's making $3 per share, or a substantial increase from $2.40 per share. So when the companies announce earnings, and if there was a metric like this that was coming out where a company is announcing from prior quarter would make $2.40, now it jumps to $3, that's a huge percentage beat in the earnings per share. And that would give the company actually a huge boost. That would be a reason why a bunch of institutional investors actually jump in and buy this type of stock. So as you can see, earnings per share, in the circumstances where the company is buying a lot of shares back, okay, do not necessarily represent the health, the financial health of the underlying company. So If you'd like to learn more about this, guys, if you're a beginner, clearly just click the link below, sign up, where we can get a trader with you on the phone who can explain this in greater detail. So for the purpose of illustration, just understand that a company can use stock buybacks to easily manipulate its financial outcomes on key metrics such as earnings per share, which ultimately could drive stock prices substantially higher. But in reality, the company does not make more money. It makes the same money. It's just dividing the proceeds by less shares. Number 4, misallocating resources from production to speculation. So the biggest issue with buybacks is this, guys. Nothing is produced. Okay, there's no money going to research and development. There's no products produced. There's no services produced. There's no land investments or improvements being made. There's no plant investments or improvements. There's no value created, period. Therefore, no GDP production, no jobs are being created. So that is the major issue with the buybacks. Now, this is not everything. Okay, CEOs often sell their own shares into company buyback announcements, basically equating this to an insider trading at its best. Now, is there anything positive? You may say, Leo, is there anything positive about share buyback? And the answer is yes, that it could actually save the market from crashing further, such as the example in 1987 I'm going to show you right now. Basically, share buybacks create the problem, but they also have the power to fix the problem. So the question is, what helped stop 1987 crash? Well, number one clearly is the Fed. The Fed went up on Tuesday, October the 20th, after the October 19th famous crash happened in 1987. And they said, hey, don't worry, we're going to provide the liquidity. Okay, we're here to serve as a source of liquidity to support the economic and financial system. No worry, the cash is coming. Okay, the second thing that was a part of actually stopping the 1987 crash was corporations announced stock buyback programs to support demand for their stocks. So it was the joint effort between the Fed and the corporations that actually created this situation right here. So here's the famous crash, 1987. Boom, we're getting slashed from 2,800 all the way down to 1,600. Basically, guys, that's almost 50% drop here. Okay, so Fed creates liquidity plus buybacks from the corporations, and before we know it, 2 years later, okay, guys, notice it's not 2 months later, okay, that we erase the losses, as most of the people believe in the V-shaped recovery. Okay, after this coronavirus situation right now, it's not going to be a V-shaped recovery. We could see something closer to this. Now, personally, after investigating everything, we could take 4 years to recover to the prior levels based on this historic analog from 1987, guys. It took 2 years at that time, but now this problem is much more severe than it was back in 1987 based off the numbers. So if companies are not buying stocks back right now, then the question is, who is buying the market? So as you see the headlines that JP Morgan suspends buybacks, you got many companies almost daily now saying, hey, we're not buying the stocks back. A lot more companies who had a positive credit rating, they're not going to be able to borrow the money as easily, or some may not be able to borrow any money at all. Okay, they're not going to be able to continue their share buybacks. They're not going to be able to initiate any new share buybacks. So if the corporations are not buying the shares back, then the question of the day is, who the hell is buying the stock market? Okay, well, the answer is quite simple. The Fed, the biggest market manipulator of all. So this move higher from the 2200s all the way to 2800 right here, this green area, was due to the Fed buying. Fed is buying pretty much everything right now. They are buying. They're buying the hell out of bonds. They're buying the hell out of market. They're buying the hell out of everything right now. So this move higher is done by the Fed. So before, in 1987, it was the Fed and the corporations. Now it's just the Fed, but doing it at the levels, at the unprecedented levels never seen before. Market will collapse when Fed can't buy no more. And you think, well, is there such a thing? Yes. And this is exactly when this is going to happen. When dollar loses more than 25% of its value, and interest rates will ultimately have to rise. So when would that be, Leonardo? When inflation rockets higher. We will let you know in the next video, guys. So subscribe, click the link below, and become the best trader you can possibly be. Buybacks are not likely to be banned until Democrats come to power, but because corporations are not able to borrow funds as freely as they have been in the last 10 years, buybacks will definitely decline this year, creating less support for the market, okay? Because now all the bond has to be basically picked up by the Fed. So learning how to short stocks, okay, will definitely make you money, guys, because the biggest engine for the markets moving higher over the last 10 years is now not functioning on 8 cylinders like your Chevy truck. It's now functioning on 2 cylinders like a little gas saver, okay, that barely goes up the hill. Okay, so considering that buybacks are not entirely gone, but the only function is just a fraction of the engine of the horsepower that they used to have, guys. There's not as much support for the market, and there's not as much support for the market because this Fed bond is not going to go forever. Okay, we will definitely see some great opportunities when markets break to the downside again, and understanding how to time and take advantage of the opportunities is what's going to help you grow your trading account substantially higher. So if you'd like to know how to profit from specific trading ideas, such as how to take advantage of LRCX, buying $5 billion at 23% of its outstanding shares last year in 2019, how could this play out in your favor this year in 2020, and how you can make money from such information, schedule a call now. Simply by going to tradingoptionslive.com, you can click right here, schedule a call, get your questions answered. If you have a strong desire to become a better trader, guys, here you actually also click right here, schedule a call. You can inquire about all the other things, watch some live trading videos, guys. Tradingoptionslive.com. Do it now. Prepare yourself for trading the markets next week. Or simply click the link below this video and get started right now. Take action. Make this year your best trading year ever. I'll catch you guys on the next trade soon. Let's trade.